Good afternoon and welcome to the April 2023 Executive Committee meeting of the Board of Education Retirement System. Today is Thursday, April 20th, 2023, and the time is 1:06 p.m. As a reminder, please note that the committee meeting is being recorded and will be posted to the BERS YouTube channel for those who cannot attend. Start the meeting by calling the roll. Cherie Gibson.
Present.
Thank you. Anthony Giordano. Tony? You're on mute.
Sorry, present.
Thank you. All right. John Matterich.
Present.
All right. Corinne Apollon.
That's correct.
Present.
We have a quorum. I'd also like to note for the record that alternate executive committee member Russell Buckley is in attendance and that board members John Dorsa and Allison Hirsch are also in attendance. The first item of business is to consider the minutes from the executive committee meeting held on Thursday, March 16th, 2023, a summary of which was included in your packets. May I get a motion to consider?
So moved.
Thank you. May I have a second?
Second from John.
Thank you, John. Any discussion on the March 16th, 2023 executive committee meeting minutes? Hearing none, may I have a motion to approve the minutes from the March 2023 executive committee meeting?
So moved.
Thank you. Second?
Second from John.
Thank you. All those in favor, please say aye.
Aye,
Hi,
John.
Tony.
Aye, Cherie.
Aye, Corinne.
Right. Any opposed? Any abstentions? The motion carries. So before we get into our first discussion, I would like to note one difference in today's meeting. After the supplemental performance report, we are actually going to go into executive session to discuss the one fund recommendation on the agenda today. And after that, we'll go into public session to have the asset allocation discussion. Does that sound good to everyone?
Sounds good.
All right, perfect. So let me share my screen and for the first item on next item on the agenda today. Can everyone see my screen?
Yes, sir.
All right, perfect. So the next item on the agenda today is the Executive Committee quarterly investment report presentation, preliminary investment report presentation. Do I have a motion to consider?
So moved.
Thank you. Second?
Second from John.
Thank you. So try and make this quick because I know the larger discussion we're going to have is on asset allocation today. But for those who are in attendance at the Tuesday board meeting, you heard from Bureau of Asset Management Chief Investment Officer Steve Meyer on the performance, the Q2 FY 2023 performance, and also heard large kind of macro themes as we head into our asset allocation. So this report is going to be supplemental to that and to also to answer a question that was raised at the last executive committee meeting. So so as a reminder, when we discuss benchmarks, in addition to our overall policy benchmark, we also discuss what we call a reference portfolio, which is 70% U.S. equity, 30% U.S. bonds, a global reference portfolio that looks at 70% global equity, the MSCI All Country World Index, and 30% U.S. bonds. And then what we call the policy PME benchmark, which uses the public market equivalent for private markets. So for the fiscal year to date, BERS total portfolio preliminarily is at around 5.3% return for the fiscal year. That's against the reference portfolios in the policy PME benchmarks, somewhere between 6.86 and a little bit over 7%. If we think about that, while private markets have been kind of a buoy for us during the last fiscal year, we're starting to see some downdrafts in private markets, some decreasing the valuations. And so the public market equivalents have outperformed over the fiscal year. However, if we look at the trailing 3 and trailing 6 years, we'll actually see that the BERS total portfolio has outperformed all but the reference portfolio. Again, a U.S. only portfolio has outperformed by 4 basis points over 6 years. As a reminder, we use 6 years because that's the amount of time we take to roll in the returns from a contributions perspective. But overall, over long periods of time, we've more than met and exceeded the overall bogey of 7%. One thing to talk about, we would like to, we're doing these reviews, thinking about areas for potential review and areas where over the trailing 3 years, we may not have performed over our benchmark. And so over the trailing 3 years, there have been 3 areas in our equity portfolio that have underperformed their benchmark: U.S. equity, EM equity, and global equity. For U.S. equity, that underperformance is really in active mid-cap, where we've seen underperformance in our manager in active mid-cap. And EM equity, this has been an issue for BERS for a while, right? Like it's been the one area out of the entire portfolio where BERS has consistently underperformed both its benchmark and then the other systems. And then in global equity, really that underperformance has been in one kind of growth-oriented manager. But overall, the other asset classes have outperformed their benchmark. But these are places that we monitor when we have discussions about whether we increase active management or go to indexation. These are the things that we want to look at and monitor after having those discussions with the head of equities and also your consultant. Private market pacing through Q1 2023. This is the amount that we've year-to-date commitments. We are well on our way in private equity and infrastructure and to meeting our private market pacing for the calendar year. A way to go in real estate and OFI. We'll see more of those recommendations towards the middle and end of the year. But at least in private equity and infrastructure, we're on our way to hitting our targets for the year.
Note that Donald joined, Antonio.
All right. Thank you, Sandy. Then, one of the we also like to consider is the allocation effect for 3 years. I think this is really important. One thing we always talk about is making sure that we get to our policy allocation and the effects of not getting to our policy allocation. For those who are on the board previously, we talk a lot about, in the asset liability study that the importance of our policy allocation and overall, what is the effect of not hitting those allocation targets? And we use the 3 years. Actually, we're coming up on the 3-year anniversary of our decision to make our last strategic asset allocation. And so you can see here modest effects on the contributor side. Things as small as 6-5 basis points to me aren't particularly meaningful. Really, this is the same story where being overweight core fixed income, being overweight cash, and underweight private equity over that 3-year time period has been a net detractor, which is why we've been so aggressive in trying to get to meet our growth assets targets, because over the long term, certainly I believe it's the expected returns from the growth assets that are going to get us to our overall actuarially required return. And being as aggressive in getting to those targets will ultimately push the plan into performing or outperforming its required rate of return. One interesting thing that we're noting is that we're starting to see some top-level valuation declines in private markets, and this is something that we've taken a look at. Again, private markets really buoyed us during the last fiscal year. Our public market portfolio was, I think, privates would have been down 14 instead of down 9 as they were for the last fiscal year. But now we're really starting to see a bit of declines in the top level valuations, which why you'll see us trailing the public market equivalent over this fiscal year. In private equity, really it's in the growth and venture strategies have taken a big dip for the fiscal year, down 5%. Secondaries as well. Buyout a little bit less so, but we're still seeing those declines. And so overall, private equity is actually down for the fiscal year just a bit. And real estate's interesting because you've probably seen a lot of the headlines around both kind of office commercial real estate defaults from some major fund managers in their REIT strategies. This last quarter we saw declines in core and core plus for really the first time, and we saw some in opportunistic. Value add to date has been holding up, but I think we do have a long way to go in real estate. We're still seeing for the trailing 1 year, really high returns. Those are going to come down, and so at least during over the next few quarters, I'd expect to see down kind of either flat valuations come down a bit more as they flow through our portfolio. Just as a note, like I said, the private markets helped us over the past year, and over the long term, you may see some detraction from private markets over the next few quarters and over the fiscal year.
Antonio, do you see that as a trend coming? I mean, I've seen it specifically with some managers that were really good, really efficient managers that have, one manager, for example, brought 8 deals to fruition last year. They were up around 25% prior to that, but they essentially equitized their portfolio, and then they're around 9%. So, do you see this as a current trend?
Yes, and in some ways, we kind of, I won't say welcome it, but I would put it this way, right? If you saw Steve's presentation around where we are for asset allocation, measured declines actually help when it comes to pacing, I think, because one of the issues we have with pacing is that we've had to drop our total commitments for the year, or our target commitments for the year, before the asset allocation, which might bring them up. But some ways it's sort of, if you can then we can kind of put money to work at more reasonable prices. So I do see it as a trend. It will be kind of muted. It won't be as again, the growth venture is say pretty aggressive for how private markets mark, but do see that as a trend, and I don't think it's necessarily a bad thing. Over the long term, it's just going to be more measured. And then, because as a perpetuity, we would like to buy at those prices versus the kind of the valuations that we had to while we were over the last several years.
That makes a lot of sense. And Sandy and I were at a summit conference yesterday, and there were some startling reveals about real estate, particularly here in New York City, but we expect would be trending across the country, that may have profound effect on real estate portfolios going forward.
So that's something scary, and I'd say that'd be more of a conversation for John Glusak and that team to get into those specifics. Because there's the idea of what's secular versus what, certainly I think if I look at private equity versus real estate, I'm less worried about secular trends in private equity than I am in real estate, right? And I think that's everybody. So that, I think that's a great creation for the BAM team on that. But it is frightening. And again, if you see that, just looking at our trailing 1 years for the core and core plus asset classes in particular, that can't right, those are going to come down quite a bit. Again, we saw that in the first quarter of this year already, and I expect we'll see it over several quarters. I think Sandy and I talked a bit about that with how long it'll take. I think over the next 18-24 months, maybe a little even longer.
Yeah, for those who watch the Twitter feed from Morgan Stanley, they announced they expect it to be a 20 to 40 month process of significant write-downs equal to or greater than the Great Financial Crisis in real estate. It takes a long time for lease re-ups and refinancings to grind through the market. And although the early indicators are Brookfield walking away from properties in both LA and Washington, and something we'll watch.
Absolutely.
Thank you very much. Sorry.
Absolutely. No worries. So the next portion of the presentation, I actually want to answer a question that was brought up both at the last board meeting, but then actually at the last executive committee as well, and the effects to date. And again, I want to stress to date of the fossil fuel reserve owner divestment that BERS and several others undertook in 2021. And so for those who are around or at the time who are not, just some background: in April 2021, New York City Board of Education Retirement System divested from several fossil fuel companies as part of its effort around its sustainable investment strategy. And April in 2021 was the first round of divestment. In this case, we directed our index fund managers through the Bureau to reallocate divested funds as to minimize tracking error. And ultimately, this is part of our overall net zero commitments. And we had ultimately have, through several iterations, You talked about what are those phases, and this was one of the phases. It was prior to the plan that came out in 2021, but it was part and parcel to how we think about our sustainable investment strategy. The divestment timeline was in 3 phases. The first was the actual decision, which came in January of 2021. Second was to divest from our indexes in U.S. equity that happened in April 2021. And then we gave our active managers to the end of the year to divest from the excluded securities lists. As a reminder, those excluded securities lists are updated on an annual basis. So some terms to know when we talk, right? Divestment is, selling or disposing of assets, either for financial or ethical reasons. In our terms, the issuer weight. So we're talking about the portion of the investment portfolio that's allocated to our particular company, particular government entity. And then tracking error, which is another thing we're going to measure in this discussion, is used to measure the extent to which our portfolio deviates from the benchmark, either of a fund or a benchmark index that it's intended to track. So a few notes on process and limitations. So we use the CAISA, so our investment book of record micro attribution module, and we compared each to their respective benchmarks. So the Russell 3000 for U.S. equity, MSCI EAFE for the developed markets, and MSCI emerging markets for emerging markets. One note, and this is an important note, about certainty around these estimates. For U.S. equity, we are 88% indexed. And as a result, I think we can better assess the effect of divestments on performance because we know what securities we would have owned otherwise, right? And also since we instructed index managers to optimize the reinvestment to reduce tracking error as best they could, right? That's part and parcel. So we have, I think, a much better handle on the effects of U.S. equity, or a better estimate in U.S. equity. For international equity, we are 100% active managed in both developed and emerging markets, and as a result, we have less certainty about overall impact. We do not know how our active managers would have reacted to, for instance, the war in Ukraine, Russia's invasion of Ukraine, and other, in kind of the rise in the prices of those securities as a result. All we know is that they held the securities at one point, and then after that we sold. So we do, and they can make decisions around how they reinvest, and so there's less certainty around the effects on international equity. So I'll talk about it a little bit later about how we try to get around that. But again, I would say the U.S. equity numbers we're fairly confident in. The international equity numbers I would take that with big error bars. And then we really didn't see much of an impact in fixed income, as you can imagine. Sector just does not have the same level of sector just does not have the same level on performance, and kind of the same effect on performance as it does for equities. So this is this chart right here. So this is our estimates using the micro attribution module for the effects of divestment of certain fossil fuel reserve owners to date. And as you see this chart on the if you think about the upper left, so that quadrant are the securities that we are not in the portfolio, so underweight, and then ones that performed very well, right? And so you can see that list is dominated by the fossil fuel reserve owners. And so this is the micro allocation effect for those divested securities. And then on the upper right, you'll see securities that we were overweight and that outperformed. And so you can see the two biggest contributors are Schlumberger and Marathon Petroleum. Last year, we gave a presentation that discussed how our index managers in U.S. equity went about the kind of minimizing tracking error. And as a result, we are overweight midstream and overweight downstream oil and gas companies, and then with the underweight to vertically integrated and upstream. But as a result, I mean, these are the big three: Exxon, Chevron, ConocoPhillips, and then EOG Resources account for the lion's share. So you can see here, this is about 111 basis points versus kind of 32 for the two top contributors, 32, and the top 344. So it has had an effect, on those are just the really the top performing securities in those sectors. And since the date of a divestment, energy has been the best performing sector of the Russell 3000, right? So over between April 30th, 2021 and March 31st, 2023, if you look at overall, the Russell 3000 has been down 2.26%, right? And energy during that time period as a sector was up more than 2.13%. So you do see that it has been a contributor to our underperformance in the index to date. Our estimate is that it's going to round, call it 120 to 140 basis points, only against the U.S. equity. To be clear, that's 30% of the portfolio. Multiplicatively, that call it 30 to 35 basis points. And in addition, our estimate of tracking error ex post tracking error on our index fund before and after divestment. So we're really talking that beforehand, and this is a little wonky, with around 12 bips, and then since the date of divestment, been up to about 60 bips of ex post tracking error. This is a top down rather than a bottom up analysis, but and so it does catch some things where some wonky times where cash flows are coming in and out of our index fund, but overall we have seen an increase in tracking error as well. International equity, like I said, is harder to estimate the effects, because again, we do not know how our active managers would have reacted. But these effects of not having certain securities as compared to the benchmark. So that's what we're really looking at. Like, what are the effects of not having certain securities as compared to the benchmark? Is substantial. Shell, Petrobras, BHP Group, BP, Total, and Reliance Industries, excuse me. So these are kind of substantial effects from our position. Again, this is to date, but again, and this could very well overestimate, because we don't know. Again, we don't know how much they would have held in these securities were they not on our excluded securities list. But this is just against the benchmark. So be frank about it, right? In 2022, the energy sector outperformed the benchmark 10 out of 12 months. And so we did miss out on some returns to that date. And in the report on excluded securities, BAM Risk estimated that the fossil reserve owner divestment would have increased ex-ante tracking error. So this is go forward tracking error by around 75 basis points. And we would estimate that to date has attracted between $25 and $40 million. Again, I say this is as of right now. Stocks go up, stocks go down, and it is, these are long-term positions, long-term policies, and so just wanted to but the question was asked asked to come back to talk to the executive committee about our estimates. Again, these are our estimates as well. We can't know everything for certain, but those are our estimates now. And again, this is through our investment book of record module. Imagine there are other ways to come up with these estimates as well, but just wanted to make sure we were responsive to the question that was asked.
And that was my.
And happy to take any questions.
Mm-hmm. Yeah, that was my question. So I appreciate it, and I'm not opposed to it. It's just, I think we should go in with eyes open and no blinders on, and really get an understanding of what the potential impact is. Sometimes doing the right thing hurts. But that's just the reality. And like I said, that's for now. The underlying rationale around particularly fossil fuel reserve owners, and not all kind of midstream and downstream companies, was really about really about stranded assets, right? Really about long-term viability of oil and gas in a world where we're going to have to use less of it. Right. And so the idea that the valuation long-term on balance sheets of the oil majors in particular would be impaired. Right. And so that's really, again, unprecedented times almost from the moment we undertook the divestment. And so, that I think is something. So, and this is not a recommendation to go back. I think the long-term analysis around what happens as a perpetuity in a world where we have to use less oil and gas. We have to. And so that to us says, hold on, but we have to track it. Right? Our job is to make sure we track it and be responsive, even if it hurts in the short term.
So just wanted to make that clear. And again, other ways to go about making these estimates.
Agreed. Thank you.
All right. Any other questions or comments on either that analysis or some of the other performance before?
No, so Antonio, I do have a question. I just want to, this is just for clarification.
Yes.
So when we're looking at this, we're looking at the impact right now, but we're also looking at the grand scheme of things as it being a long-term investment over time. Is that correct?
Absolutely, 100%, 100%. This is this is a snapshot of a moment in time after a tremendous rise in oil prices. Because again, if we would have looked at this, and as I said, that's why the snapshot. If we looked at this if we would have divested in 2014, we would have net been made money, right? Like so, there's always endpoint analysis is always, I say dangerous, but endpoint analysis always can depends on what endpoint you choose, right? And the question was asked today and not at December 2021, or it wasn't asked 5 years from now. It was asked now, and right now this is what it looks like.
Thank you.
Absolutely. All right. Any other questions or comments or on either again the general performance or the divestment discussion? All right, hearing none, the next item on the agenda, let me do this real quick. The next item on the agenda is a fund investment recommendation. Per Public Officers Law, Section 105, 1H, executive sessions may be held if the discussion is about the proposed acquisition of securities or sale or exchange of securities. So this will belong in executive session. May I have a motion to enter executive session? Thank you, Donald. May I have a second?
Second from John.
Thank you, John. Any final discussion for public session? All those in favor of entering executive session, please say aye.
Aye, Donald.
From John.
All right. Any opposed? Any abstentions? The motion carries. We are now in executive session. Before we get to the last item on our agenda, I will report out on executive session. In executive session, the Executive Committee approved a commitment to an infrastructure fund. The final item on our agenda today is our first of what will be a few discussions on asset allocation. Do I have a motion to consider?
So moved.
Thank you, Tony. May I have a second?
Second from John.
Thank you, John. As some of you who attended the joint NYCBERS meeting yesterday saw Head of Risk Ed Berman talked about some of the considerations that the Bureau of Asset Management and our consultants are considering, using that word twice, considering while thinking about the strategic asset allocation for over the next several years. And those were really kind of large macro considerations like inflation and geopolitical considerations, changes in stock bond correlations. And so that is one ingredient as we're discussing a new strategic asset allocation. But today we wanted to talk about a few issues that we think should go into the overall discussion and into the recommendation. And so today, we're going to have three presentations. The first is I'm going to give some context for the asset allocation, some history and some key questions. And then Deputy Director Salil Mehta will discuss his investment liability modeling and how that can enhance our recommendation. And then Siegel Marco advisors will go over their capital market expectations and asset classes and how they build up those capital market expectations. Siegel has already been in discussions with the Bureau to, and have shown their capital market assumptions. And so we'll be all kind of in concert as we move forward prior to the recommendation. So just some key questions for trustees and really for everyone as we're thinking about moving forward. One of the, it's been 3 years since we've reviewed and set a asset allocation, which was done for BERS in April of 2020. And in the IPS, it says that we should review asset allocation every 3 years. However, certainly the change in the basket clause that was signed into law literally at the last hour last year is one consideration where we would want to review asset allocation. So keeping in the back of your mind, are there other considerations for rather than just calendar considerations for reviewing asset allocation? We want to talk about how expectations have changed since the last asset allocation. Ultimately, what are the characteristics of a portfolio that is expected to return 7% over the next 3 to 5 years? What are those current expected returns for stocks, bonds, cash, and alternative investments? Are there new asset classes that merit inclusion in the portfolio? And I think a huge question is, should we increase alternative asset investments to the new basket clause limit, which has gone from 25 to 35, or is there somewhere in between that would balance kind of the return opportunities with the risk of investing too much of the portfolio in illiquid assets? So to give you all a historical context again, I wanted to talk to you about the changes in BERS asset allocation over time. So we reviewed BERS's strategic asset allocation every year since June 2009, excuse me. So first, and this is kind of big picture, we'll dive into each of these broad asset classes in a moment. So you can see, really BERS, like most public plans, has considerably increased its allocation to alternatives over the past 15 years. And really have switched from investments in public equity and to a certain extent public fixed, but really public equity, and utilize that to invest more in alternatives. And so to June of 2009, BERS's asset allocation was 60% public equity and only 10% alternatives. And you fast forward to our last recommendation, that's down all the way to 47% target and with a 26% target in alternatives. And so that's really the story of, again, almost all, or not most, public plans that switch from concentrating almost all of our growth in equity risks to broadening it out to alternatives. And if you're to look into where that's really come from, our public equity allocations, except for emerging markets, has kind of declined in U.S. and in developed markets, but really in developed markets. So in 2009, 21% of assets down to 10%, and that's really for basket clause considerations, because if we're going to increase alternatives, then the place to take it from really is developed market equity. And so our equity allocations declined over time, but of that 13% decline, 11% has come from developed market equity, and we've held U.S. equity still in the 30 to 35% range, and that's really basket clause consideration. Now that helped. We are more overweight U.S. equity as a percentage of the overall global market cap than we were previously, and that has helped us because the U.S., as we've seen many times, has outperformed the international equity by substantial margins. In public fixed income, we've shifted to taking more credit risk, and we've balanced our core allocation to be closer to the Bloomberg Barclays aggregate. So at a high of 22% down to 16% for core fixed income. But what's not shown here again is that the sector allocations have become more balanced. We had a high of about 66% of the core fixed income allocation in government securities, and that's more balanced now. We're off 40-30-30 to look more like the Bloomberg aggregate. We've increased high yield bonds considerably, and we've started and ended our bank loan program, and then U.S. TIPS, so Treasury and inflation protected securities, has been relatively stable. And also, like I said before, I've seen a steady increase really across the board. We've almost doubled our allocation to private equity. We doubled it and trimmed back a little bit our allocation to real estate. BERS started an infrastructure program alongside the other systems, and then started its private credit opportunistic fixed income program in 2020 with the last asset allocation. And just one note that prior to 2016, the real estate and infrastructure allocations were joint. They're called real assets allocation. So last things before I turn it over to Salil, was just I just wanted to give you some economic and pension indicator data to give you a sense of how much things have changed from during that time period. So we are making this decision under very kind of vastly different economic circumstances. So if you think about, so we have, 4 categories here, kind of what the Fed's fund rate was, 10-year Treasury, global growth for the previous year, and then kind of inflation. And you can see here that, in those 2 areas in particular, we essentially, since 2009, have never made an asset allocation decision outside of zero interest rate policy. And with, inflation that we haven't seen, certainly haven't seen in my lifetime, but, Sandy's seen in his lifetime, I should say. And so
whippersnapper, Antonio.
But yeah, so I think that kind of gives us we're starting from a much higher rate, and the implications of that ultimately, we were kind of pushed into alternatives in a lot of ways, through zero interest rate policy intentionally. Do we meet that limit now? And does fixed income become more attractive, and especially core fixed income more attractive when rates are higher? And the other thing you'll say, the pension is as healthy as it's been since before the great financial crisis. And so this is truly stunning. When we were looking up the market value of asset and actuarial value of asset funded ratios. June 2009, our funded ratio was market value 54%. The actuarial value assets funded ratio was 68.7%. And so you can see, as of late as June 2016, we were still 60% funded from an actuarial value perspective. BERS is now over 90% funded, close to 100% funded from a market value basis. Actuarial value, because there's because the actuarial value is lagged by 2 years. This is the same one from June 2020. We won't get to 2022 until 2024. But just to give you that kind of that remarkable run up, the contribution, and a lot of it is because it's for a few reasons, but including the contributions as a percentage of payroll went up dramatically after the funded ratio crashed to more than 25%. But importantly, the net cash flows, and I think this is something that is really important for this asset allocation, is that, and what really I think helped BERS a ton is that for each of these asset allocations, that we are still net cash flow positive. So this will be the first time that BERS is doing an asset allocation, strategic asset allocation being cash flow negative, right? And so great position from a funded ratio standpoint, but now paying out more benefits than receiving in contributions. So that has some interesting considerations. And then finally, a few key takeaways before I turn it over to Salil. The progress made in funded ratio has been dramatic over the past several years. So a combination of being cash flow positive, tier 6, aggressive asset allocation, and the leverage effect from the TDA. The next presentation, we'll talk about those implications, because now that we're negative cash flow, we've made progress in funded ratio, may mean some pressure for benefit improvements. The TDA is now a larger percentage of assets than it was back then. And then the changes in approach to active risk, like things like our implementation plans and the deterioration in some of our active performance. And then importantly, capital markets expectations still play a role in these assessments. They always will, right? So understanding stock bond correlations, higher starting interest rates, and equity return assumptions will be key to this recommendation as we're all working together to come up with the recommendations. And we think ultimately by including this review of liabilities and assets, we can come to I think more robust recommendation. And so with that, I will turn it over to Salil Mehta to discuss investment liability, his investment liability risk as a component and augmentation for the asset allocation process.
Thank you, Antonio. Can everyone see screen right now? Liability risk. Can everyone hear me?
Yes, yes, we can.
Okay. All right. Well, so yeah, thanks. Happy to talk about some critical investment risks in the portfolio, particularly on the liability side. This discussion will sort of look at differentiating between issues that arise in asset allocation, and then some of the more modeling nuances on the liability side, and what this implies for BERS and the investment landscape. It's challenging material, but I have plenty of time to go through it, and a few minutes, for questions and answers that can be interjected in the middle as well. Let me see if this, okay. For the agenda, which I show here, I'm first going to talk about, as I mentioned, the differences between traditional pension asset allocation and liability risk, and build up to a summary, which is that for BERS, it's likely at or beyond the contribution risk tolerance, as we make some definitions of what that means and what we should feel comfortable with and what that sort of implies. I also will discuss the mathematical complexities and innovations on modeling on the liability risk side. And I'll note up front, this work could not have been done without the help of the actuarial's office. So I don't know if American's team's on the call, but I've done the modeling to do the investment work and then have used a platform calculator from them to take my output and then get a dashboard and a sort of a vector of actuarial output, which then I fed back into a machine learning process to look at those results and recreate simulations and so forth. And so I want to sort of make that and give a shout out to them. Then I'm going to look at just the actual assumptions that are currently for the pension and baseline simulations that sort of serve as the foundation of the liability risk modeling. I look at sensitivities around that baseline and pretty much an infinite set of those sensitivities, so that we're not cherry picking specific stress scenarios, but we sort of look at the entire dashboard and talk about ways in which there's still risk that remains after that modeling. And that's in things I've talked about previously, like strategic asset allocation. There's parameter and model assumption risks and errors sort of inside of that process. And so when you see a disappointment in terms of performance relative to expectations, that generally can come from either one of two places. One, the model was right, but you happen to get some variation that was expected, or simply the model was wrong to begin with, and you're sort of going down that wrong path. And so I sort of show kind of how easy it is to see things beyond what's modeled. I'll look at just one last slide on contribution cash flow sensitivity and a summary. And as a bonus, I have a couple sort of appendices of sample formulas in the back for people if they wanted to look at them, but it's just I won't go through them, but it's there that covers this space. Does that sound good for everyone? I can't.
Absolutely.
Thank you. So, excuse me. So asset allocation versus liability risk. So for asset allocation, the focus there is to optimize the yield, the risk-adjusted returns, so those sorts of metrics. It assumes a fixed investment duration, and more importantly, for our work, it has a poorly defined first-order risk, which is at the core of that process. It's it's a pretty loaded term. It's poorly defined, but this is the type of math and the type of work that was sort of around in the mid 20th century. One of my advisors won the Nobel Prize in economics on looking at solving some of the formulas using these types of tools that were around then, which we don't have to deal with now. The tool, sort of the math around having, say, a normal distributed return set, which we know isn't really true, and we can actually solve for that better today. Assumptions like the risks are the same for all asset classes in terms of its distribution, therefore can be modeled in a specific way where even their correlations and their dependencies on one another and across time are equal. They're very sort of hand-waving assumptions that make this type of math work, but we can branch off from that, which I've done in the liability side, and that it doesn't assume sort of in asset allocation causality. It assumes a very homogeneous trend and volatility, and there's no possibility to incorporate policy changes. On the liability side, we're able to do a lot more complex dimensions of investment modeling and tie that up to funding accounting. it links the investments to the pension liabilities, not just at one endpoint, but across time, so that you're able to make decisions, feel comfortable about them over time. It uses what I've been able to model is fairly sophisticated, and there's sort of hierarchies of modeling liabilities. And at the very basic level, you could do geometric or var covariance style modeling. After that, you can do things like binomials, and then and I mention this because the sort of after that, people will use things like log normal stochastic modeling. So you'll see that term sometimes thrown out, stochastics, which is kind of a loose term. I don't think it's very accurate for this case, and I've done things beyond that. But that term gets used there, and also gets used in other places like solving sort of risk and risk functions. I've written a book on statistics where one chapter is just on stochastics, and so it's just what I've done here is something a little bit beyond that, and so I'll use the word simulation going forward. There's also things like Monte Carlo modeling, and all of these that I've discussed so far doesn't assume causality, doesn't have fat tails, they're very symmetric. What I've done, which goes one step even beyond that, is the simulation. It's very continuous time. It uses things like copulas, which allow you to use joint risk among asset classes. So things that you saw last year, which seem on a sort of old-fashioned risk tool to be very rare, like you saw bonds and stocks both fall double digits. That seems rare, but it would not have been rare if you considered that asset classes can, especially when there's a risk event, can be correlated and dependent on one another. And an example of that is things like the funding ratio for BERS and for some of the other major pension funds. They've dropped double digits sequentially 2 times in the last 20 plus years. And so imagine that as just a sample window of 20 years. Imagine if you want to go off 30 years and expecting that you wouldn't see something even worse than that. These would only be rare if you're using an old-fashioned sort of elliptical risk model. So I've been able to sort of model this, the partial causalities, and I can assume things like trend changes, volatility jumps, and policy responses in terms of the actual modeling. And so now let's just go into it. And it helps to sort of see a illustration to sort of, before it gets kind of mathy again, about kind of what we have here. So imagine that you have a dark room and it's got a couple windows in there, but at the back end of the room, you see there's a flashlight sort of going through the window, and you see a shadow, and the shadow is a parallelogram or a rectangle. You would assume perhaps that the object in the room that's producing that shadow might be a square, a cube, something with that sort of shape. And you can think of this, we can analogize this to, this is the room being your 30-year horizon, and you're looking at simply what's at the end and making an assumption about what is the characteristics that led to that result. And in reality, there's multiple ways to get there, and you can see that you could have a very different shape risk over each of the years along the way that still lead to that same result, but it's that risk along the way that you have to make decisions on and think of tolerances on, and you could be sort of doing the same thing as figuratively squeezing this square peg into what's a round hole. And so what we're doing on the asset liability side is essentially looking at what is this cylinder, what is the sort of dimensions of the risk along the way, and at the same time having to tie out to what's on the asset allocation side, which is that square at the end of the process, and they both need to come together. And if you make the wrong assumption along the way as to what you're seeing, you would make the wrong choices, and it'd be more erratic. So hopefully that sort of clarifies a little bit what at a high level. What I've done on the simulation side, in terms of on the investment side, we start with the actuaries assumed 7%. What that means is they're assuming a 7%. It's a arithmetic compounded without any volatility year after year going out for 30 years, maybe more. But what I've done is see, okay, well, what would be the funding contribution risks that once we start deviating from that? So let's go up or down a level 100 basis points. And then I put in a baseline simulation of 6.7%, standard deviation of 15%. Now, why did I get to 6.7? And why is that, perhaps slightly similar but different than other numbers you might see floating around the marketplace? And the reason for that is because when you go into a continuous mode of modeling, which we have here in the simulation, the actual return has to be what you want to see minus the standard deviation squared times 2 divided by pi. So it's a little confusing, but it goes down a little bit, and I have some formulas back there, but it's going to be a little bit less than what you might see when you're using sort of more discrete time. But it's close enough. It's 6.7, a little less than 7. And now I've run a battery of simulations around that. So basically, doing a level shift up or down on 6.7. So you want to get a little bit higher return or yield. You might want to imagine returns a little bit higher than that, a little bit lower than that. You might want to do twists or turns around it. And so one way of thinking about this is if you got 14% return in the market this year, followed by 0 next year, that's different than if you got 0 this year and 14 next year. Even though at the end of 2 years, you still average 7%. But in the realm of funding accounting, it has a very different output in terms of your contribution and your funding risk. And so I've looked at this and stretched this in a number of different ways, and I'll show a heat map with some kernelized statistics around that. And here is I deconstruct what is the contribution risk. And you'll see it's asymmetric, and there's some important aspects to this. What's in silver color is what is the employer contribution that's expected if you got 7% assumed return year after year for the next 30 years. And you can see it floats at around $200 million a year for about a decade, then it starts shaking off. But it stays under around $350 million. What's in orange that's above that is that baseline that I described, where you have a 6.7%, slightly lower with a dispersion around it. And you can see that it fairly closely hugs the assumed contribution risk for about a decade, and then it starts branching off. And this is the average. The median would actually come in closer to the assumed, but when you have these sorts of simulations, you'll see that there's going to be a skew and tails and so forth. And so on average, a 6.7% return would give you employer contributions that start getting up closer to $500 million out 30 years. That's the average. Now let's look at the range around that. And so for that orange baseline, this is the middle 1/3 of scenarios of the distribution. It's not a very large test. It's roughly a half a standard deviation plus or minus. That means you have a 1/3 chance, 1 out of 3 chance that you're going to see employer contributions that go up slightly more than what the dashed line is still your average. And you have a 1/3 chance of walking away perfectly happy, and after 10 years not having to, or you'd feel comfortable with 0 employer contributions for that point forward. That's that middle third, and that's for a 6.7. Now let's see if it was, instead of 6.7, let's see if it was 7.7 or 5.7. And you can see in yellow, if you went out for an extra 1%, you can see the yellow doesn't change that much from what you saw before on your baseline. Yeah, there's a slight improvement in your employer contribution expectations, but the key here is that being slightly less or underperforming by just 1%, you're suddenly going down the red track, and you have a much more dire employer contribution just in the middle third of the range, just for that 1%. Now, let's talk about this using sort of another actuarial metric, which is the funding ratio. This is just going out 10 years, 2033, and I'll show a number of other statistics that converge to this. And we can look for, I don't know if you can see my cursor, but we're going to look for this little cloud that gives you a set of opportunities that are between 6.7% return, 12% risk, sorry, over here, and 7.2% return, 15% risk, just this little zone here on the patch field. And you can see that this solves so that having that higher return with slightly, with higher risk, you get a very small, about a standard deviation, but a small funding ratio improvement. You can see you go from yellow to light green. It's not something that we'd otherwise even notice. However, the downside is that slightly higher average funding ratio comes with a larger variance around it. And so I show what's the probability of, instead of getting that average, you wind up with greater, on the left, greater than 130% funding ratio. And on the right, I show the probability of instead getting less than 70%. We're not talking very extreme, but you can see that you are in a very convex way getting significantly higher probability, almost a 1 in 3 probability, that just stretching out in that way, you could wind up in a situation where just 10 years down the road, you're at sub 70% funding ratio, even though the average was a very small amount more. And this is the way to sort of frame up what is the expected risk you're able to tolerate for that enhancement on the market curve. So what I'm going to do here is look at not that outer third, but let's go all the way out to the extreme tails. This is still looking at 2033, and I show this is purposefully compressed here on the vertical axis because I've censored employer contributions below 500 million. And so you're only looking in this case. So if right over here where my cursor is, and hopefully you can see the cursor, but you can see where 1.5 billion in employer contributions. It's these final bars here, and it's the upper bars. It's the amount that's in white silhouette as it goes down, and it's roughly 0.2% of all the scenarios. So it's a 1 in 500 event. Doesn't seem like much, and that's fine, 1 in 500, but this is just 10 years down the road that you would have to be paying a $1.5 billion contribution for that year. And then, going forward, it would evolve. Now, that's for 2033. And meanwhile, you could have picked this closer to the other extreme, sort of in that zone, which is 6.8%, 12%, a tighter risk. And you would follow the red curve, which is always by a factor of 4 to 1 lower on the tails at any step along the way. If I take this out to 2042, so now we're looking at maybe 20 years down the road, you suddenly get a larger dispersion in the tails. So instead of it being a 1 in 500 chance, you're now at a 1 in 30 chance that 20 years down the road, you would be having to go from what was otherwise a $400 million contribution to a $1.5 billion, a significantly larger increase in a contribution, and then taking this out to 2051, and you can see that the numbers get fairly sizable in terms of the probabilities. And there's other ways in which you can, and that, this assumes your expectations come true, but like I said, you could have other ways in which you could have disappointments on top of this. You can have higher inflation costs, which we know comes in at like a 2-to-1 ratio. You could have longevity change mixes. You can have higher volatility than what you were expecting. And let's talk about some of those disappointments, how they happen. And there's many ways. Just 2 years ago, there was a failure for many investment professionals to see a large backup in yields, which impacted a lot of asset classes. It was a major event. Right now, we have the markets that are fairly not necessarily discounting what heuristics would say could be a lost regime, for example. You have 20 years ago, I show here in the upper right, you had emerging markets that was expected to completely trounce developed markets and U.S. markets. You can see that in blue, but the reality now that we see it 20 years later has been almost a 2 standard deviation event to the downside. We've seen this repeatedly in a number of different ways, both in terms of the returns, the correlations, the covariances, and the risk that you see, like the risk of what you saw last year in stocks and bonds, never really got made up for in the future. You can't amortize future gains and say, well, I made up for that loss. And you can see that in the blue dots here on the bottom, where every time you get these downturns repeatedly, they smooth in, and your actuarial assumed and the market assumed return expectations have continuously come down 200 basis points in 20 years. You've never made up for, when you see these declines, ultimately, they've not been made up for, is the point. And it won't get necessarily made up either. So, for example, we had the last year's markets in stocks and bonds, and you'll see a slight pickup in assumed returns for the next 20 years starting today after the crash. So it goes up maybe half a percent. But if you amortize last year's loss over that same period of time, you're still down versus where you were pre-crash. And then that's at the very top level, but this ricochets down to other areas. For example, the exposures you have that are almost beta-like in specific asset classes, and that in specific managers where you can have a huge buildup, almost a multi-decade buildup in excess performance that gets mostly cleared out, not completely, but mostly cleared out in a very small fraction of time. And it happens sort of all at once in a few sort of asset classes. Very hard to sort of make up. The question was asked in the previous board meeting about sort of what if you're starting to look at your optimal investment space and you start adding additional constraints. You have non-traditional filters, whether it's ESG or something else, and there's no other way that this would benefit from a liability standpoint. It just amplifies the tracking error and the exposure risk of sort of investment execution. So if you think about this way, and Antonio sort of brought up some points in the previous conversation, but even if you assume that the things that you want to emphasize or de-emphasize in the portfolio for social reasons, let's say that it has a perfect linear correlation to the underlying market, and as a result also has a beta or has a beta of 1 as well, you would still have this amplified tracking error, which doesn't show up in the near-term actuarial funding risk, because you're going to smooth it in, and you're just beginning to implement small changes. But we are at that point where it's convex, and you will see that increase over time. I'm sorry if I'm not able to on my screen look at chats while I speak. So if there's something that's worth flagging. Instead of raising your hand, or just shout it out. I'm used to doing lectures and with like multiple screens here, but I only have one to look at. So hopefully everyone's awake. So the so just a little bit more on this. The parameter misfits are overlap areas of high risk. And this is something that we call the curse of dimensionality. And it happens both on the asset side as well as the liability side. On the asset side, when you try to carve off a specific investment space and you ask for more and more constraints, the amount of possible opportunities that are going to fit what would have been optimal for you before you made those constraints becomes significantly smaller. And on the liability side, if you look at multiple asset classes and look at how do you model extreme risk, it becomes smaller and smaller your data set in terms of having something in your data set that sees that joint risk all at the same time for all the asset classes. And so it becomes very hard to model it, even though it exists, and it becomes even more difficult as you start thinking through alternative or non-traditional asset classes where you don't have that same time history to model against. The last thing I want to note is something that's very important when you look at investment forecasts and so forth is that famous disclaimer, which says everything, but yet it's in such small print. So here it is in small print. I'll just read it for you because many times it gets glossed over. Nothing's guaranteed here in terms of future performance. They do reflect high levels of uncertainty and are subject to change without notice. How do you think about the precision involved in some of the numbers and the choices that are made, and then that level of disclaimer, and you have to balance those two together and ask yourself sort of kind of how you use both of those pieces of information. So I'd like to talk about the cash flow cliff, or what.
So Salil, one thing I know you go a little bit, running short. We still need to do Siegel's performance as
yes.
well. So if you could, for the last 3 slides, kind of wrap up in the next 3 to 4 minutes.
Okay, yeah, perfect. Let me do that. Yeah. So cash flow cliff. Looking at 2033 and what was going to be the cash flow contribution that was expected. If you go back 3 years to 2019, we were expecting to make a contribution in 2033 around 75 million. Market went up and the contribution went down to 0. And now with the market fall, it's gone up to 200 million. And just think about for a moment what you've seen before. Ask yourself about what would you do if 10 years down the road, I don't know how many of us are going to be in the same boardroom talking, but 10 years down the road, looking out 10 years to 2042, and you're staring at a very high probability of, at that time, high probability, like a third chance of a $1.5 billion contribution, and asking sort of the questions in the room, how did we get here? What could we have done? And so forth. That's something that I think is an important lesson to take from this. And then I'll summarize on the last slide that the modeling just shows that we're near the appropriate risk tolerance. It's more critical now than it was previously to be accurate. You have assumptions that are coming down. You have longevity mixed risk that's increasing. And that active management combined with other filters, it will progressively amplify contribution risk. We saw that with the cash flow slides previously, that it's going to start diverging. What I show here on the right is that there's different ways in which you can think through different asset classes where you can lower returns, you can increase volatility, you can increase sort of how much you need to contribute or the inflation, and you can see where the sources of reductions in our specific assets should be. And hopefully we're able to get to a point through this process where we're able to restrain the ongoing contribution stresses without having to sacrifice too much in the way of return. I'm not going for a maximum amount, but an adequate amount. So thank you very much. That was my presentation.
Thank you, Salil. And to summarize, and I think it's really important to state, given our state of the world, right? Given our state of the world, how can we, and the analysis that we're able to bring to the table, how do we best balance those two, critical components? And so at the same time, then we still have to figure out how to invest, right? We still have to decide where the money goes. And so with that, we then want to start talking Frank Salamone and Vanessa Vargas from Siegel Marco to discuss, all right, given all of these, given all our constraints, given our goals, how do we put that all together to come up with an appropriate asset mix? How do our consultants think about it? How does the Bureau think about it? How we can combine all of their inputs to come up with an appropriate asset mix that we think can combine, all of those goals and constraints without blowing up contributions and making sure we have an adequate return. With that, I'll turn it over to Vanessa and Frank and Christian to discuss their views, give an introduction on asset allocation and the asset classes and how they've come up with their capital market expectations.
Thank you, Antonio. Can you all hear me? Can you hear me?
Yes.
Okay, perfect. Good afternoon. And before we go through this deck, I wanted to say that the strategic asset allocation process has always been a process of collaboration with internal staff, but also with the Bureau of Asset Management. This will be the first of many presentations, as Antonio mentioned, that you would hear from us. And we plan to come back to the trustees with, once we've started more in-depth conversations with each of the parties that will be working on this jointly to provide you all an update on where we are. As an update, and I think Antonio mentioned it, but I'll repeat it again, we have had just one meeting with the Bureau of Asset Management. It happened earlier this week where we introduced our capital market assumptions and allowed the permissions needed for them to compare and share our capital market assumptions with not only you, but also with the rest of the systems, as well as the rest of the consultants that are involved in this process. So with that, let me start with, just basic definition, the next page on asset allocation or strategic asset allocation. It is the process, as Antonio said, of allocating dollars across different asset classes, and the assets or the dollars that you have on the plan, really the objective is to make sure that they are going to be paying promised benefits to plan participants. So with that in mind, as fiduciaries, we want to maximize risk-adjusted returns to either provide the highest given level of return for a level of risk, or take the least risk for a given level of return. Those at the top level is the main goal of a strategic asset allocation. A lot of what you heard from Salil right before us was more asset liability study, and let me just remind all the trustees that are here that we did conduct an asset liability study, and let me know if you need a copy of that. We'll be happy to send it out to all of you. So if we move to the next slide, there are considerations, and part of our job is to provide you considerations to ensure that you can make an informed decisions, and there are many considerations to take into consideration for into a strategic asset allocation. For the BERS portfolio, cash flows are really important. So one of the considerations is the current monthly pension benefit payment and also the future ones. And because we have done an asset liability study, we also have data in our system about the future benefits that are owed to participants. The fact that the assets today for the BERS portfolio are combination, really. For one is for the qualified pension plan, and the second is the tax annuity TDA, and the TDA represents about 28% of those total assets that we that we've talked. You've heard from Antonio that there are specific plan characteristics, and Antonio and Talil have both mentioned plan characteristics to you also. I won't repeat that, but one of characteristics is funded status. You are over 90% in terms of that, but also liquidity. How much illiquidity do you take in a strategic asset allocation, or how much illiquidity you decide to pull back? And also your particular as fiduciaries risk tolerances for each of the asset classes considered. If you go to the next page, Christian. So it is really multiple inputs that go in before we even run a first scenario of multiple portfolios. And we will be running multiple scenarios of multiple portfolios, and a lot of, I'm not going to repeat all the data that's here, but a lot of these are the different inputs that go into the exercise of the strategic asset allocation that we do. On the next slide, so the last asset allocation study, Antonio mentioned, it was approved in 2020, but actually the study started in 2019. So the initial conversations about the strategic asset allocation started in 2019, and it was finalized with the trustees' approval in 2020 and the addition of that strategic asset allocation into the IPS, investment policy statement. That's what IPS stands for. So here are the, where you are today, and these are the asset classes that were considered back then with the elimination of bank loans. If you go to the next slide, it shows you on the right-hand side of the page other asset classes. And these are just a few of other asset classes that can be considered. And right now, we will, the first step will be to have discussions with the BERS investment staff, the controller's office, consultants, and look at each asset class by asset class, the merits of it, and also the merits of continuing with the current asset classes that are in the IPS, in the current target, and deciding what makes sense to continue utilizing it going forward, and which ones make sense to add, which ones make sense to delete. And then coming back to you all as trustees to have that discussion with you all and the decision of asset classes for consideration. And then so what we're going to do next, I'm going to pass this to Frank. And what Frank's going to talk to you about our asset class assumptions. And that is our forward-looking capital market assumptions that are behind the model of this exercise that we will be conducting on your behalf. Frank?
Great, thank you, Vanessa. When we really think about how we come up with our capital market assumptions, we don't do anything in isolation within our group. We really do a collaborative effort across the firm to really come up with these assumptions, because they're very critical when you're talking about trying to create an asset allocation. Everything is only as good as the inputs that you go into your decision-making process. So really, it's a combined joint effort between our group of risk management, our portfolio solutions group, and especially also our alpha research team, because they're also very close to everything else on how basically we're deriving these assumptions. So our group that I sit in is in the risk management department, and we really are the ones who derive the capital market expectations and the modeling assumptions. Okay, Christian, can you go to the next? Thank you. So when taking a broad look at our assumptions, we really use a three-pronged approach to really derive these capital market assumptions. The first thing we really think about before we ever invest into risky assets is how much can we earn from a risk-free asset? Because that really helps derive and say, how much should I at least be able to minimally get without taking any risk? And that's really done with our yield curve analysis. So our yield curve analysis projects out how much our cash rates should be over a long-term time horizon and on a year-by-year basis. Now from there, we then derive our risky asset assumptions, and that's really used as a building block approach to really come up with saying, what fundamental measures do we use to really derive how much we should expect to earn out of stocks, bonds, alternative asset classes. And then finally, we really check those with saying, given inputs of risk and correlation, and market weights. Do our assumptions really make sense? And that's really where it comes into the reverse optimization model. So using these three methods, we really use that to derive how much we should have expectations for all our asset classes that we publish assumptions on. When we think about those assumptions before that, we're thinking of them as everything has a risk premium, which we then attach that risk-free rate to. And that's how we really think about how we decompose returns. The next slide that we are on is really our guiding theme to our 2023 assumptions. As Antonio was saying, this is a very different environment than we all have seen in a very long time between inflation, yields. Really, a lot of things that we identified is that, right now we still might have further rate hikes. Inflation is a major issue that we are dealing with that is different. But it's also led to, say, fixed income yields have been quite higher than they have been in the past. For years, you were really not earning a lot of money at all from fixed income and were pushed into riskier assets and also into private assets because you could not earn anything on a significant portion of your portfolio. The other real main issue is that cash has been up 90 basis points from where we were from last year. We're also noticing that valuations have come down significantly from their highs due to these market corrections, but they're still at slightly elevated levels. So while it's not as egregiously priced as it used to be, it's still not screaming a buying opportunity. Okay, let's move on to the next. These next couple of slides really detail out our main capital market assumptions. And what we're doing over here is we're showing you the long-term capital market assumptions on a 20-year basis. So as you can see here, we make asset class assumptions for across fixed income, equity, and also the alternative asset classes, which will be on the next slide. But just to highlight a few of these important asset classes, as I said before, cash is expected to earn around 3.1%, which is a notable increase from last year. Core fixed income is also up as well. And I'm looking at the compound return, or the second column, at 3.9. When we look at equities, I don't know if we want to zoom in a bit, but it's around 7.5 for US equities. I think we could see that. And really what we've noticed is that, returns are up essentially from last year. So the outlook for the long term is higher returns, which is going to be, a positive tailwind for us. Okay, let's move along to the next. These are just also our alternative asset classes as well. Great. So now we want to get into how we actually are starting to derive our assumptions. As we said before, one of the main events that are going out on here is that much larger inflation. So right now, our new inflation assumption was raised from the prior year. Now we are up to 2.4%. Now I know that seems kind of low compared to our 5% number that we saw on Antonio's slide, or what we see in any kind of headline inflation number that we see. But really what we have to say over here is these capital market assumptions are long-term in nature, in terms of this is not just the next few years inflation. This is our inflation expectation over 20 years. And it really hasn't been raised until about this year. This is really where we had a big boost. Now, this is also built up on a building block basis. We take into account multiple sources to really derive that expectation of inflation, ranging from Cleveland Fed, Philadelphia Fed, break-even inflations, and so forth. So that's one notable change, that we are up to 2.4. Next slide. This next slide details out our cash model. There's many levers that go into this, about 7 main items that factor into our cash assumption. And right now, what's interesting about our projection about cash this year is not only that it's up 90 basis points from the prior year, but also is that we have an inverted yield curve assumption for the first time. So historically, every single time we've ever done capital market assumptions, we've always assumed an upward sloping yield curve, whereas the nearer term returns are lower than the longer dated returns. It is now flipped on its head with this inverted yield curve, and that's just something we couldn't avoid given the term structure of rates. Okay, next slide. All right, the next main areas that we wanted to hit on were core fixed income. Core fixed income it has been very much along the lines of being de-emphasized in a lot of client portfolios in the longest for the last several years, just because the yield was very low. If we really dissect how core fixed income returns are derived, we really could say that a great predictor for future returns is the actual yield to maturity that you would get on that today. So the yield to maturity on the Barclays Ag, as you can see from this chart, is a great predictor of future returns. Now, the one time where it's finally broken down was when we had, this 40-year spike in inflation. That's where you can see the orange line going below the light blue dot on that chart. But for the most part, as long as you hold that asset class for approximately the length of the duration of the index, you're very much going to have in line a positive relationship between the two, such as the higher the yield, the more you should expect to earn out of core fixed income, and also vice versa. So this is another asset class that was raised as well. So our risk premium went up. Moving along into more of the return-seeking asset classes, the next slides I want to cover are on the U.S. equity building block returns. So when we're looking at equities, we like to think of, these are once again long-term assumptions. What are the basic drivers behind our equity return assumptions? Equity returns can really be decomposed into these four major areas, such as inflation plus the dividend yield plus real earnings growth plus plus or minus a valuation adjustment. Will give you what your long-term expectation of returns are. Now, with inflation, we already had the inflation assumption derived from our previous slide. One thing to note was that the dividend yield had improved. The dividend yield had improved just because the prices had corrected and come down a bit. Growth is kind of one of those areas where we had to say the earnings outlook and the growth outlook has kind of come down slightly. But luckily, that was also offset by the reduction in beforehand when we had a negative valuation adjustment. So in the prior year, prices were very much elevated, so we had to have a negative adjustment for the valuations going forward. But now, luckily, we were able to reduce that as the markets corrected. So let's go along so we could see the actual numbers. So this next slide really shows what are the actual numbers that we put into this building block. And those building blocks really were composed of our inflation assumption of 2.4 with a 1.9 dividend yield, a real earnings growth, which was slightly lower to 2.9, and a 0 valuation adjustment. That should give us a 7.4 expected return on a compound basis. And this is a long-term projection. All right. Getting into several of the alternative asset classes. Several of the alternative asset classes we really zeroed in on to try and say, should we really look and say, how should we adjust up or adjust down our assumptions? A couple of asset classes that really stuck out were the core real estate assumptions. So the risk premium for core real estate, we definitely dropped. There are a number of areas that have a positive outlook in real estate, but there's also a number of negative areas of real estate. As we can see on the next slide, we really did this reduction by about 1%. And that was just due to the office sector and the retail sector have very negative outlooks that we derived with assumptions around with our alpha asset team. And really the only other offsetting were positives across the apartments and industrials. So it's a mixed bag, but overall, we really were much more negative on terms of what the risks are going forward. So we reduced that asset class. And that's a major asset class for a lot of our clients.
Yeah, and so what we tried to do today was to give you a little bit of a snapshot in terms of how we derived some of those assumptions on an asset class by asset class basis. We did not have the time to cover every asset class that you have on the strategic target allocation, but we do have a bigger deck that covers every single asset class, not only that you have, but asset classes that we model in our assumptions. What we did here was we took your current targets, and in our conversations with the BERS investment team and the controller's office, we have decided that we're going to use our expected 10-year assumptions for the strategic asset allocation analysis. So on this page, what you see is your target on that first column, and the first circle in red is what that portfolio would give you in a 10, in terms of a compound return for the next 10 years. So you are in a 7.9% return given the current target, with a standard deviation of about of a little bit over 13%. And you can also see here on this page the last line, the basket clause, where you are in terms of basket clause. So right now you are almost hitting that 25% original limit that we had. Now we know that we can go up to 35, but some of that discussion is that we are going to be having with you all is, are we comfortable with that 7.9%? Are we comfortable with that standard deviation of 13.2? Do we reduce the return? And what happens to standard deviation? Do we increase the return? What happens? And every portfolio that we plan to show you will always be in comparison to the current target that you have, and what are the takeaways from those comparisons. So that's some of the things that you're going to expect from us. In terms of the key takeaways, that we wanted to leave you today on the next slide is because we have done an asset liability study and we've done several of your asset allocation studies, we have really the knowledge and the considerations on both the assets and the liability side for the BERS portfolio. We do have to consider, and you all have to consider as well, the fact that you have the QPP with an assumed return of 7% and the TDA with a return of 8.5%, and that the assets are, combined or, invested together. You have to also consider that while you have an increase now of the basket clause to 35%, how high do you want to go, or where your comfort is in terms of that increased limit. You don't have to go to the upper level. You don't have to, increase illiquidity if you don't need to in terms of what your return objective is. And I think that's something basic is, we've always advocated our clients to have diversification in terms of asset classes, and to me it's more like we don't want to put all of our eggs in one basket, and we want to make sure that the overall portfolio and different parts of the portfolio behave well in different type of market conditions. As we know, not every asset classes, not every asset class is moved together. Some of them actually move separate differently. And that's part of the reason why we want diversification across the different asset classes and not just a few asset classes in the overall portfolio structure. And with that, let me see if there's any questions. I know we tried to keep you in line in terms of time, so we may have rushed or talked a little bit faster, but we're here to answer any questions.
Any questions for Siegel, for Salil?
One question, just and a quick one, just because we're human beings and recency bias is a thing. As we are looking at asset allocation, how much do we consider the current moments we are in versus that 10-year horizon, and how do we prevent ourselves from being victims of recency bias?
So, and I'll take it, but I'm happy to pass it on to I think one of the reasons we wanted to talk about history, right? And I think that's why it's critical to talk about, several asset allocations and positioning you all, because if you would have transported somebody back to 2009 or 2012 and saw the position that BERS was in, I mean, again, we were 54% funded, right? 15 years ago. And, but I think it's critical that the trustees there, the Bureau, our consultants, kept folks on that path. So I think understanding that that long game, like, it got us, again, without taking anything for granted now, but that long game got us to a much better position, right? And that even applies to the state legislature, labor, everybody contributed to that. And so I think that's first. And second is that, And I think Steve Meyer talked about this both yesterday and on Tuesday. We really can't move that fast, even if we wanted to, right? And so that actually helps a bit, right? Where we just can't take as much recency bias into our analysis as we would like. No, hopefully we don't like, but as even if we wanted to, we couldn't. I guess that's something that I think the rebalancing ranges are pretty tight, right? And so I think we've put in place things so that recency bias can't play as much of a role, I think.
Yeah, I agree, and I think that when we look at the strategic asset allocation, we are looking, we are taking into consideration the opportunities that they exist today, but the opportunities that are going to exist and kind of weather a portfolio over that 10-year period, not just in the next 1 to 2 years. We want to make sure, because this is a long-term portfolio. You invest for the long term. You pay your participants not only today, but those participants that are accruing towards the future. So we want to make sure that it's not just the opportunities that lie today, given the market environment today, but also where we're thinking markets are going in the next 10 years.
Thank you. Any other questions for Salil or the Siegel team? So the last thing I'll say, and again, we'll have another conversation in May, but the last thing I'll say on this topic for today is that kind of what you all as a committee and ultimately the entire board of trustees are charged with is setting asset allocation that gets to our assumed rate of return, taking a prudent level of risk. And I think what we wanted to talk about today is like, what does that risk mean, right? And I think one of the things that's been a hallmark of our engagements with Siegel, our discussions with BAM, our internal discussions is that defining what risk is and risk being multifaceted. It's partially volatility. It's also the contribution risk. We are perpetuity, we're long-term. And so how we think about risks should kind of be that hallmark, because ultimately you're charged at the end of the day for that vote. And so I think that's really the charge that we have, is thinking about what does it mean to have either undue risk or a prudent level of risk given all of these parameters. Next in May, we will invite the Office of the Actuary to talk about liability structure. And so talking a bit, just to give some context to Salil's, to Salil's discussion in particular. But in addition, having, maybe some narrowed, discussion on narrowed, portfolios or any updates in the conversations that we're having with the Bureau. So I think, that will be for next time. But again, those key questions that we will send out, think about them. And always, I know, Tony, you talk about this a lot, but get second, third, fourth, fifth opinions, because ultimately you're the ones who have to make the decision. So, having as much conversations either with fellow trustees, with other systems, with folks at the comptroller's office, having those one-on-one conversations to get a better understanding, I think will be crucial for you all as we go through the next few months and ultimately set an asset allocation. So, so thank you for the attendance. Thanks for the questions. And with that, that's the last item on the agenda. So, no other business. We just need a motion to adjourn.
So moved.
Thank you, Tony. May I have a second?
Second from John.
All right, thank you, John. All those in favor of adjourning, please say aye.
Aye, John.
Aye.
All right, nobody opposed, right? All right, we are adjourned. Our next meeting is scheduled for Thursday, May 18th at 1 p.m.